realbusinesstalk.com.
Interest rates are both very simple. I mean, you can define them with a number. For the retail customer, which is virtually everybody, most every bank denominates interest rates in eighths of a point. So you'll hear 3 5/8, 4 1/2. You won't see what the real cost of money is. That's okay. That's standardized within the industry. That's what an interest rate means, and the rate you're going to have on your loan, of course, is going to affect your payment. But how that rate is derived and where the trends are and what's going to happen in the future, let's face it, it's an everybody guess kind of thing. What I try and avoid is the responses to the immediate market reactions. These days, the news media is very transaction oriented. Whether it's a health issue like Ebola, whether it's a confrontation overseas, whether it's something, it becomes a giant topic temporarily. So every time the market or the Federal Reserve or some pundit announces, for instance, that rates are at an all-time low or rates have dropped, I'll get 40 or 50 phone calls from people who think, great, rates are incredibly low, we should do something. The funny part is, the next day when rates go up, I don't get anybody calling me to say, hey, I heard rates have gone up. Truth is, over a period of time, at least for the last several years, rates have basically been flat. Yes, they will go down, they flutter, they fluctuate, but today's drop that might get talked about in the news is really not much different than where they were last month or 5 months ago or almost close to a year ago. They've been extraordinarily low from a historical perspective. I carry with me a chart where I graphed, is it show? You can slug it in, but I graphed the 30-year fixed rates for the last 40 years to document, at least for my own comfort, that yes, in fact, rates are lower than they have really ever been. What that means is it's a great time to take advantage if you're buying. It's a great time to take advantage if you're refinancing. There's no reason really you should be paying more interest to a bank than you need to. There's no reason you should pay more interest to a credit card or anything. It's just money out of your pocket. The reason that the concurrent reason why that's of value now is if rates are at a historical low, there's every statistical reason to suspect that rates are going to increase at some point in the future. Where I inveigh against the transactional point of view is it's hard to point to a time when that's going to happen. So the market consensus is rates are going to rise. True, but I don't really think that means anything. In the fall of 2014, there was recent announcements that the Federal Reserve is going to stop purchasing mortgage-backed securities. Your mortgage is a bond. So if they stop buying bonds, what that meant to the market was the people that sell bonds are going to have to offer a higher interest rate to get bond purchasers to want to buy those bonds, because those bond purchasers would therefore make more money. So if the Fed stops buying bonds, you'd expect interest rates to rise. Where I think that argument is faulty is the Fed made this announcement last spring. The market is sophisticated, or at least I'm going to say the market is smart. This is public knowledge. This knowledge is already baked into the interest rates. So by the time an announcement like that gets to the retail level, to an individual client, it doesn't mean that rates are going to jump up just because the Fed made that announcement.
realbusinesstalk.com, connecting expert talk with real business success. That makes your network your net worth. The tools you need to succeed in real estate, in business, in your life. Join the talk. Receive the latest business talk. Subscribe now at realbusinesstalk.com.